It wasn't like the Fed built up a store pile of cash or capital to buy something. They just created it out of thin air, as people like to say.
Congress is more broke than anyone because their credit cards are maxed out, but every year they get a new credit card, and then they write their own spending limit increase.
It's almost like this Black Swan event that's happening over. Hey, what's up, man? Did you change?
Just my hat. New hat.
All right, that's funny. We always joke because we'll sometimes do back-to-back recordings, and I'm like, the people that are watching YouTube are just going to see that it looks like we wear the exact same clothes every week, and I just want you all to know that Hans is trying to fake it. This is just 10 minutes after the last episode.
Yeah, different Remnant finance hat. But,
yeah. So this episode. What's up? Go ahead.
I don't anticipate anyone's actually noticing that, but
no, I don't think so either. I doubt it. By the time a week passes from when they saw the last one to the next one, they probably don't notice that I'm in the same clothes with the same haircut with the same dark shadows under my eyes.
And if they care, we don't want you to call us.
Yeah, that's fine. This is just my lucky recording shirt. It's like hockey players who haven't washed their underwear in 8 years. I don't ever wash this. I just put it on because it's my lucky shirt.
There you go.
No, that'd be nasty. I don't do that. Yeah, so we figured we'd talk about a little bit from the, recent macroeconomic news, 2025, how it can relate to IBC, Fed rate cuts, all kinds of things going on, and we'll just kind of hit some high-level overview on what's happening in the world, what inflation looks like, what you can do about it, which is really the most important thing, since none of us can affect real change on a macroeconomic level, but we can affect micro change and how we handle it and how we deal with it and what we do pointing forward.
Yeah, I'd say that if we summed up 2025, and again, this will be early January when it comes out. If we isolated kind of the big macroeconomic headlines, 2025, it's kind of hard to find it's kind of hard to just use those to figure out a game plan. And so our overarching case we want to make is that you need to be resilient against all possible outcomes. Right? Last week we talked about estate planning and how there's a whole infinite number of ways that your life and death could go and how those assets that you have will be distributed, thinking through and having a plan resilient to all these outcomes. So financially, we want to be the same way. Now, we're not going to default to this typical conversation of just, okay, diversification is not just having different sectors of the S&P 500 in your portfolio. That's not what we're talking about. If we're talking about diversification, we're talking about diversification across our entire asset strategy, across our protection, across our savings, across our growth. So one element of the strategy needs to be growth equities, because some of the headlines point strongly towards continuous asset price inflation. However, we also want to have our guarantees in place because some headlines and some big themes point towards potentially, what if we had a lost decade in the stock market where we just matched inflation? So the big themes that I've identified, or that in reading every day the macro headlines, obviously inflation is the biggest one. Inflation and the debasement trade and QE. We'll call those kind of one bundled up concept. Forward PE, the forward price to earnings ratio. We'll talk about what that is and how that could be a possible counterweight in planning to this inflation debasement trade. We'll talk about the Fed rates, talk about tariffs, and we'll talk about the wrench that's throwing a wrench into all of these previously held truisms about macroeconomics. And that is just I'll call it AI, but it's really just the aggressive acceleration of all of these cycles, how quickly things are being replaced and how quickly things are breaking. Like week to week now, things are breaking, paradigms are breaking that could totally upend different models. And so that sort of ties into all of these concepts. And so the main thing to be ready, like the big takeaway here, is you need a solid growth and investment strategy, and you need guaranteed safety assets that are not market correlated. Those two things should sound familiar. Protect, save, grow.
Yep.
That is it. Like that again, all these things point back to this because how do we get resilient against this? So which of these do you want to talk through first?
I thought there's two angles on the rates, and we've got opposing views on different sides of the world. One, that Japan has recently raised its rates, which can send shockwaves across the world to the highest they've been in 30 years, I think. And they're indicating that they may raise them further next year. And then here, we're slashing rates again, like you mentioned, starting likely more quantitative easing. And I read something a few days ago. I was just looking it up. I couldn't find the quote that more or less Jerome Powell has said that they're along for the ride now because there's nothing more they can do in any direction. Like they've got themselves painted in a corner. He didn't say those words specifically. Obviously, that's my interpretation, but I can't find the quote that kind of was just like the "oh crap" quote. We're stuck in a corner. So I say we start there with the interest rate changes around the world and how that can affect us.
Yeah, the yen is a big one, and you might be wondering why you never hear about the euro, for example, when we're having these macroeconomic conversations. Europe, as an economy, has become they're quickly just diving headlong and intentionally into economic and military irrelevancy. But you always hear about the yen. You don't hear about the Australian dollar, the Canadian dollar, the euro. Always, well, obviously, we focus on dollars, but we don't even talk about like the Chinese renminbi. We talk about the yen, and the reason for that is because among central banks, the yen has been kind of the sponge. So in our group, I put out people were talking about this post that we saw, and so this is Andrew BTC, but the post said Japan will crash BTC. Bank of Japan is set to hike rates 25 basis points on December 19th. Hey, that's today. The largest holder of U.S. government debt being Japan. Look at Havry, and so this is a Bitcoin guy focusing on the impact on Bitcoin, but this is saying every time the Bank of Japan hikes rates, Bitcoin dumps over 20%. So my thought on that and what I said, my understanding of essentially what we call the yen carry trade. Here's what I wrote. I said the yen's been held low for decades. While other central banks change rates and do normal macro things, the yen stays suppressed. For 40 years, they've had a stagnant market. That's the price that the Bank of Japan has paid to maintain a seat at the table. They are an enormous and very important economy, but if you look at their market, their equities over the last couple decades, it's been stagnant. That's because all central banks know that if all else fails with their auctions, or better put, if their treasury auctions fail and the central banks need help monetizing the debt, they go to the yen carry trade. So it's not just central banks, but also primary dealers. We're going to talk about primary dealers in a little bit. Everyone can buy yen because no matter what the rates are domestically, you can still go and buy a ton of yen and then turn around and invest that in higher yield assets at home. So that's my understanding and brief explanation of the yen carry trade. If the yen goes up, if the Bank of Japan, their central bank, their Fed, raises rates, which they should have done a long time ago according to all economic central banking playbook guidelines, it means they can't keep being the whipping boy that absorbs the rest of the central bankers' carry trade. If they do hike rates anywhere near where they should be, it's basically the first time in our lifetime, essentially. It's been 30
Yeah.
plus years, nearly 40 years that they've been stagnant. So they're kind of the Bank of Japan sort of has assumed the role of the central bank of last resort to central banks is the kind of the simplified understanding there. It's kind of like everyone knows, no matter how tight in the pinch we are here, we can always just buy a ton of yen and arbitrage it on minor swings. So it's a huge deal for them to put that friction onto the global system. And again, it sounds kind of choppy because I'm reading my own post here just to refresh myself. But my reading on the yen carry trade has always been in the macro realm, but it makes sense that Bitcoin responds negatively to yen getting more expensive. Bitcoin reacts more strongly to liquidity than anything else. Liquidity is a function of the lowest common denominator. As long as money can always find a low tide in yen, things move. If yen becomes priced where it should, that liquidity dries up Bitcoin response. That's my take on the yen carry trade, and that's why I think that is a big deal if Japan is raising rates. And why are they raising rates while we're lowering rates, right? We're all over the map here, geographically and monetary policy wise.
Yeah, and you actually nailed it. Like that last statement you said is a creates a big liquidity risk on our end. And it actually, we have to pay more to borrow because of that on like a structural basis across the global markets. Yeah. So while they're doing that, creating this potential liquidity crisis on our end, which it strengthens the yen. And so now that trade off is weaker on our end as far as the dollar goes. We're now lowering the rate, which means there's a good likelihood of more quantitative easing, which we alluded to in the beginning, which again is going to lower it's going to increase liquidity of dollars in our market and lower value of the dollar.
Yeah, and
So
it's not even
where's that tie
likelihood.
in?
Yeah, it's not even likelihood of quantitative easing now.
Good point. Good point.
They've announced it. When they announced the last rate cut, they said they're going to be buying, starting this month, $40 billion of assets here. So that's not theory or speculation. Like, that's actually what's happening. So now, so what quantitative easing is essentially is the Fed is going to buy Treasury bonds. Like during COVID, they increased that enormously and just bought a ton of Treasury bonds. But they're buying it from those primary dealers that we mentioned. That's 24 financial institutions that are authorized to trade directly with the Fed. So you got the Fed as is the big daddy, and then you've got 24 banks, 24 financial institutions that get to reach into daddy's pocket, right? So JP Morgan, Goldman Sachs, Citigroup, Bank of America, Wells Fargo, all these like big names in Wall Street, they get to interact directly with the Fed. This kind of gets to the Cantillon effect, which is the idea that the money benefits those who interact with it first. So how do these asset prices keep going up? Why is QE? Why does the Fed saying we're going to do QE lead to higher housing prices, higher stock prices, just general asset price inflation? It's because when the Fed does QE, what they're doing is they're going to, say, JP Morgan, these other primary dealers, and they're buying securities directly from them. And so the Fed now has these securities and they put cash into JP Morgan's Fed account. That cash
Yeah,
didn't exist.
basically JP Morgan is the seller of those securities. So
Right.
it's still a transaction in a sense. They're selling it. The Fed is buying that and pumping that liquidity into that came from nowhere, by the way.
Right.
That's the point. It just came from nowhere. It wasn't like the Fed built up a store pile of cash or capital to buy something. They just created it out of thin air, as people like to say. And now they're purchasing those mortgage-backed securities, or they're purchasing the treasuries, one or the other typically, and they're injecting that money right into, think of it as their bank account. So now JP Morgan and the other associated places have that much more cash of dollars in their account to start with, and then they make moves.
Yeah, and that's the thing. Like,
Yeah.
so they purchased they purchased those treasuries, those securities. They probably purchased them from the treasury auctions. But regardless of the price now, the Fed's going to buy it from them and give them cash for that didn't exist before. So then they take that, they reinvest it, they push prices up, buy stocks, they buy real estate, so everything goes up. And then that money makes its way into the economy at some point, right? So that's asset price inflation. When they're talking about QE, that's going to happen because they're doing it currently this second, or I think the number is 40 billion for this month alone that they're going to be buying, putting that money into the economy. So when we talk about inflation, we're talking about the supply of money. That's where it comes from. Now, I'll still make the case that it's Congress is like the devil in the details of all of this because they can't stop their spending. When they can't stop spending, the Treasury has to issue more treasuries, and then the Fed comes in and buys those.
Buys it. Yep.
So so a lot of the animus towards the Fed is well deserved, but it's also it's like it's a small part. I mean, sorry, not a small part. It's a major part, but it's not the only part of the story, and it's not actually the root cause. It's more, I'd say, it's more the effect. The cause, the input factor, is the spending from Congress. They cannot trim the budget. Doesn't matter. Like Trump talked about trimming the budget. Doge had a good press releases and stuff. It seemed promising, and then Trump released the biggest budget ever. He increased everything. He
Yep.
spent more. He's going to spend more than Biden did. Biden spent more than Trump did, and Trump spent more than Obama did. Like they're all doing it. There's no situation where like the only people that are actually calling this out, Thomas Massey and Rand Paul, are the ones that Trump's on a scorched earth campaign. Idiotically, he's getting rid of the people in his party that actually tell him things that he needs to hear, i.e., don't contribute to this. Don't keep invading countries and expanding wars when you got elected on a promise of ending wars. Don't keep spending and blowing up the deficit when you got elected on a promise to trim the deficit and bring in government efficiency. Like these things have all gotten worse under Trump. He's continuing and escalating these. And so the spending is the root cause. The output, the result, the effect is that the Fed comes in and does what they shouldn't be allowed to do this. Because if they weren't allowed to do this, Congress couldn't keep spending
Yeah, they would
because
have
Congress
to
would
be
have to
constrained by the
tax.
budget. Yeah.
Yeah, they'd have to tax. And so it's like
Yeah.
these politicians in Congress, if they had to vote on a bill and say we're going to give, you know, $10 billion today to just throw it in the meat grinder in Ukraine, and it's all going to get bought up by, we're going to enrich contractors in the Beltway, and then we're going to send equipment over that's going to be instantly demolished. And we know there's no value here because this is a lost cause from the start. Like, we're going to blow this money, right? And we vote for it in the name of patriotism. Well, if they had to do that and then say, hey, by the way, constituents, I'm going to have to raise your taxes in order to fund this, they'd all be lynched, right? They'd all be, like tarred and feathered and sent out of Congress. So they don't do that because they know it's not palatable and they can just kick the can down the road. And so they just spend on the deficit. It's like they've got a credit card. Who needs Dave Ramsey is Congress.
They
Congress
do.
needs
They
Dave Ramsey.
severely need them. Yeah.
Right. Like broke people, poor people need Dave Ramsey. And Congress is more broke than anyone because their credit cards are maxed out, but every year they get a new credit card and then they write their own spending limit increase.
Yeah. They do. And one of the things to think about too is some of the people who are fans, like larger economists and folks out in the world, that when the first rounds of what we know as QE, whenever it was first labeled that in 2008 after the banking crisis occurred, and I think there was 4 major rounds, if I'm recalling everything correctly, and we didn't see massive asset inflation for years, and we didn't see an inflationary effect on our money as quickly as people said. And then a lot of the proponents of QE and the Fed policies said, see, it doesn't do what all these what all these like Austrian economists who said we're going to have hyperinflation and things are going to go crazy, and they were wrong in some ways. But one of the reasons is that when the banks get that liquidity from the Fed, they're not forced to do anything with it. They're not compelled to move that into the market. They're not compelled to write more loans. They're not compelled to do anything with it. It's an incentive. They're incentivized to do so but at that time, whenever there were banking crises, what did they all do? Not all of them, but the majority of the large banks, majority of the mortgage-backed lenders and those things, they held on to that as extra liquidity to save themselves. So it took years until their lending practices loosened up and it started to enter the economy. And that's why, like, I don't know what's going to happen right now as this happens, but we can look back to 2008 and say, well, why didn't it cause hyperinflation? Well, it's just because the banks were in such a precarious position that it's like, oh, cool, we got all this money from the Fed. We're going to sit and wait, and we're just going to play it safe. So they actually did what, they were in the protect and save mode as a bank. Well, now, and then that all changed in 2020. It was just like free money everywhere, and we actually felt the inflation. What do you think is going to happen this time with
Yeah.
the new policies?
I think it's going to be a much more quick impact that we're gonna see there, and I to me it's preposterous that they're still doing this. I mean, it's not. It's believable because they have shown
Yeah.
zero. There's shown zero inclination again outside of Thomas Massey and Rand Paul. Congress has shown zero inclination of any appetite to stop spending. So, well, in that case, why would the president? And so philosophically, I think they should raise rates right now. I'm against
I think
what
so too.
the president says. And I think that Jerome Powell was right to hold them for as long as he did and wrong to cave to the pressure. Now, some of the people that I like and read the most, like Anthony Papagliano, I think is one of the most accurate economic podcasters, content creators right now. He's a big advocate. He says we should be cutting even more. And that's with the expectation that cuts going to lead to economic growth. And therefore, like that's a good thing because account balances go up. But I still come back to this is a fever. And what we're doing is we've given them an infinite bottle of whatever, ibuprofen, like fever aid, trying like the fever itself is the medicine, right? The fever is not the
Right.
illness. The fever is expelling toxins. When you are sick with a fever, Your body needs to raise the temperature so that it can expel toxins. That is the medicine. Like going through those symptoms, the heat, the sweat, the feeling sick, even just a regular cold, that's healthy. Cold should not be fought. You shouldn't fight a cold. You shouldn't fight cold symptoms. The cold is the medicine. The fever is the medicine. You have to go through it to get back to health. And so in the same way, this spending, I think it's like they're not going to stop spending, but we can at least make it more costly to do so, and we can break things quicker. And I think things need to break. I think the fever needs to break. I think the toxic load is so strong, and so I understand. I understand on the other hand, countering that position that hey, why would we impose austerity on ourselves when the people who are responsible for running the budget cannot do so, will not do so, and none of them, apart from two of them, want to do it, or at least vocally are staking their political reputation in saying the right things in spite of a president who like will not tolerate people disagreeing with him publicly and
Yeah.
just go scorched earth on the people that are saying the right things. In this case, they have no appetite to do it. So if they're going to keep doing it, we should raise our boats as well, and like we're going to benefit from asset price inflation, those of us who own assets. So I get it, and I would concede that if Congress isn't going to do their part, and they're the most important part because the Fed is the second part, not the primary. Fed's not the primary problem. Congress is the primary problem. If they're not going to do their part, then I guess it makes sense to lower rates to at least stimulate the assets that we enjoy because we're not going to get those. We don't get primary dealer privileges where we can benefit from those rate cuts directly, but indirectly we should. Now, let's shift gears a little bit here and let's go to the other side. At the same time, the bond market doesn't buy it, right? So this is where we get into the next big headline. And that, I mean, it's kind of the Fed rates again, is more continual on that line. I think they should raise rates. I think they should make it hurt more until it breaks, get back to hopefully any kind of budget constraint, but that's not the cards. So nobody believes that they're going to do it. So what happened when Powell cut rates? Did we get these big spikes? Did the mortgage rates drop? No. What happened to the mortgage rates?
They
They went
stayed the
up.
same. Well,
Well,
they even went up a little bit. They kind of
yeah,
did nothing.
because the mortgage rates, the when you have to put your money on the line, you're much more honest than when you can just say something. So like a political poll, people say one thing, but the betting markets, poly market, those kind of markets on elections are much more accurate than just people saying something with no strings attached. When you have to attach strings on it and you could lose, that's much more accurate. And so it's kind of like the poly market, the betting market, Vegas is the bond market, the 10-year treasury market, because people actually have to stake money on what they think the cost of money is going to do. So the Fed's cutting rates and the 10-year treasury is going up. These are supposed to be correlated, and they
Right, and they're
were with
decoupled
LIBOR.
right now.
Right.
They're, like, decoupling as we speak, yeah.
Yeah. And so,
And so
so the
structurally, like, that's a big signal of risk whenever they decouple if they don't run together.
right, because you're saying, and mortgages are based on the 10-year treasury. They're not based on the Fed funds rate. That's where we're not going to see a
Correct.
move because the Fed funds it. Because the bond buyers are calling their bluff and they're saying, hey, you're saying things are fine, so you're going to lower rates to stimulate economic growth. We don't believe you. We have to put money out for 10 years. Is the 10-year outlook looking like you're saying it, or is it not? And they're saying no, it's not. So Fed funds rate's going down, but remember the Fed funds rate only impacts short-term borrowing, 1 and 2 year treasuries at most. That's for trading now, and that's for banks that are trading with each other, trading now in the short term. We, home buyers, bond investors, stock investors, we're saying if we're talking about rates here from our perspective, we're saying we don't believe you. Big bond investors are saying we don't believe you. Look where the money is. Follow the money, and the money says the Fed's full of shit. Like nobody's buying that this you know this narrative, and so that's a counter position there to hey, this is like this yield curve inversion is a big deal when people are saying like I have so little faith in you that I'm gonna go against the grain of like common economic thought and we skewed the time value of money equation when we're talking about interest rates here. And that's what's happening. And that's a big deal.
Yeah, because that's like reflecting kind of risk pricing of what the real economy, the market economy is expecting versus what the Fed is signaling and the government's trying to signal. Am I kind of hitting that right?
Yeah, yeah. And these are indications. Like the takeaway from this, from these two things, to me, is we need to be positioned in growth assets because they're going to continue to debase. They are showing, even though the bond market is calling the Fed's bluff, the Fed and the Treasury and Congress are all showing their hand right now, saying we will not stop printing. We will not stop spending. We are not even going to attempt to cut a single dollar from the budget. And in fact, President, Congress, Treasury, Fed, we are going to add more fuel on the fire. So that to me says I need to be in low stress trading. I need to be doing whatever in your asset portfolio is your best rate of return with market exposure. That data point says to me markets are going to continue to go up, and I need to make sure my equities boat is patched to rise with that tide because I don't want to get left behind by just being, say, in life insurance and cash value and saving. I don't want to just have, I mean, I don't buy bonds. I don't think there's any reason to buy bonds when you understand life insurance,
No,
but
I don't think there's any
just
reason
having,
whatsoever. Yeah.
no, no, and it's like, so I'm not just going to rely on my cash value guaranteed growth in light of this inflation and this debasement trade. That narrative to me says I need to be long the stock market, not because there's value being created, but because they're going to continue pumping money. That is an argument for strengthening your growth component to me.
Yeah, I agree. And because like all these projects that look profitable under this low end thing, they're going to be revealed and or under like ultra low rates. That's going to be revealed that they're high risk. So we have to be long those types of projects, if you will, that are out there. And it's not just the stock market, as like you mentioned the equities, but like what else do you have going on? Are you in a, like you said, whatever asset class you have that is showing the best growth? I think that there is potential for a whole bunch of asset classes that you can be a part of to get in front of this. But the key is probably going to be ownership. I still do believe that, whole life insurance is going to outpace any other savings plan that is there. It's still going to be the phenomenal foundation that it has always been. But how can we leverage that into other assets? And they have to be true assets. Ownership is going to become more and more important, especially as everything changes, not just with what the Fed's doing, but technologically. Like if you're not in the ownership class, you're going to get left behind with
Yeah.
those two things combined. Technological changes we're experiencing and what the Fed is doing and what the inflation signals are. Got to get into the things that you own.
Yeah, absolutely. I we're going to roll from this into forward PE because I think that's the logical next step here. But on that note, obviously your life insurance is not an investment. It's not your growth component, it's your protection and savings. But when we talk about the growth rate, the guaranteed compound growth in a policy, we typically call it around 4 to 4.5% as the internal growth rate on the policy, what our cash value is doing. But that's when we factor in dividends on this, and we factor in projected dividends in the future. I'm building a system where in my retirement years, I could be generating a $150,000 check in the form of a dividend tax free if I choose to reallocate that from purchasing PUA to taking it as income, which I might do down the road. And so, yes, the internal growth rate of my cash value is one thing, and that's a consistent guaranteed compound that I need and want, and that you need, even if you're all in on growth, you need that as well, in my opinion. But those dividends are nothing to, they're nothing to like, to shot, nothing to scoff at. I mean, imagine the size of an equity portfolio I would need to pull 150 grand year over year tax free. I'd probably need to pull about 200 grand that's going to be taxed to have about 150. Now, I mean, a ballpark here, but those dividends only go up until I start taking them and reallocate from cycling them back into the policy. It's all about, this is not about policy mechanics here, but like having a robust, large whole life policy in light of this growth component, this debasement trade we're talking about, is still a very strong asset to have. It performs down the road incredibly well right at the time I need it to. But
Yeah.
again, it's not your growth assets. Now, you said something there about basically looking forward at the market and expectations, and are we overvalued right now? But do you think we're overvalued right now, like the stock market in general?
I think so, and I think that I think it likely is extremely overvalued, and the more that we manipulate things, and the more that we have lower interest rates, that just creates like false assumed future potential and earnings. So yeah, absolutely, I think we're overvalued.
Okay.
Do you?
Yeah, yeah,
Yeah,
we objectively are. I think we are, and I know we are, and I'll make the case right here. Something that you probably not, if you're just casually like see headlines, you might not see this. But if you're pretty regularly reading about macro, if you have a personal interest in finance, you've probably read about the obscene price to earnings ratios right now. And
yeah,
more importantly, for this discussion, forward PE. What that is basically is the price of a stock relative to its expected earnings per share over the next year, right? Earnings per share. So take the stock price, which is the price of one share, and you divide it by the expected earnings over the next year of the company divided by the number of shares. So basically, how much is a share expected to appreciate in the next 12 months? Now that's a subjective guess, right? We don't know. That requires there's PE where you look backwards and you say what actually over the previous 12 months, how much did the share price go up relative to what you would have paid for it 12 months ago? That's backwards looking, and that's a more concrete data point. But for our purposes, for we're talking about planning for the future, I mean, that's good to know,
yeah.
but
There's
we have
nothing
to,
fact based there. It's just they're just forecasting like guesses,
right. Which,
right?
yeah, and those analysts typically, like the analysts that stay in business, are the ones that generally get it close.
Yeah,
Um,
and but
this,
it's all but isn't that all manipulated too by like the interest rate and the time preference because of those interest rates and that liquidity? Like, so there's multiple factors there that just make that a best guess that has no actual metric and reality on what these companies are actually doing.
it, yes, as far as if we look at today, we look at what does an analyst say this company is going to make over the next 12 months? Yes, it's a guess. It's an educated guess, and they're not like wildly. It's not like your advisor just saying you're going to make 8% a year. Like there's money on the line here, and the market quickly snuffs out analysts who don't get close because there's companies that are staking their entire profitability. Like everything in the market is built on these earning projections, right?
Right.
The stock price moves, and so like yes, it's a guess. Yes, it's not concrete, but there is a lot of value to it, and more importantly, the trend that we're going to talk about is documented. So it's like you take the future, and then we get that number, and then we look backwards and see in 10 years how that would have gone. So we have this selection of data points that have gone from like future 1 year outlooks to the past, and now a year later we say, okay, well here's what the forward PE was a year ago, and now we're actually at the year. So that data point has moved from theoretical to concrete, and how did it actually perform? And when we look at it in the past, not see, this is the thing. You could look at the past and say, here's what the actual experience was. But we can also look at the past and say, here's what at the time the forward PE would have said. So we have here was the guess, and then here's the result. How accurate were they? And when we look backwards with that, we can chart basically the ratio, i.e., the stock price relative to earnings. A high ratio would be for what we're at right now, for instance. So basically, how expensive is a stock relative to what it's expected to earn? So currently, we're at 23x for the S&P 500. That's
Yeah.
historically very, very high, which means you'd have to pay a dollar, or sorry, you'd have to pay $23 for every $1 of expected growth, right? So in 12 months from now, we could have this conversation, December 19th, 2026, and we could say, okay, at the time, the S&P was at 23x. Well, let's look back and how did that prediction perform? And they're pretty close. But now we're going to get into another narrative.
Well, I guess what I was trying to say is that, like, going back into this conversation, if we're gonna, the Fed just dropped rates, and they're
Right,
planning on doing it more. So those lower rates and the analyst predictions, that's going to like justify a higher multiple of the forward PE.
right.
And is that an accurate assessment? Because or is that mispriced, I guess I should say, on the time preference that is given with those lower rates. So you know what I mean? Like from an Austrian view, like it doesn't necessarily those things conflict because those are artificial time preferences based on lower rates where they can manipulate and justify higher forward PE ratio.
Yeah, sure. But then the stocks do correspond to that, right? Like if asset prices are going up because of these rates, like we don't experience the mortgage drop as home buyers, for instance, the point we just made.
Yeah.
But the corporations that are getting this money first, does their stock correspond to this? And so my point is that generally this forward PE is a good metric to look forward and say how expensive are stocks now. We don't know what the future holds, but are stocks basically overvalued right now? So a higher PE means stocks are more expensive, and i.e., you're paying not just that their dollar is higher, right? But that you're paying more per dollar of earnings. So Amazon stock versus, even like, all right, Tesla versus MicroStrategy, right? One's like $480 Tesla, and one is 160 right now, right? But it's not just saying it's not. I'm not saying that Tesla's a more expensive stock because it costs 3 times as much to buy one share. I'm saying if you look at their PE, how many dollars is that one share expected to be able to purchase, right? So higher PE, more expensive. Lower PE is cheaper. You're paying less per dollar of earnings, right? So that's the metric that we're looking at. Now, where that ties in though is if we look at a chart and you on the x-axis you graphed out the multiple. So right now we're at 23. You could be down at 10. It's like a conservative market where things are priced conservatively is 10, right? So a $10, it takes $10 of purchase to expect to get $1 of profit. Right now, you have to spend $23 to expect to get $1 profit. That means we're just saying that the market is overvalued. So right now at 23 times forward PE, if you put the X or the Y axis on there, it's basically the annualized return of the market over a 10-year period. Now that's looking back over 10 years of data using these 1 year, like 12-month snippets. This future PE is 23, but a year from now, that'll be a data point in the past. So we can chart on a dot plot every one of these snippets, right? And we could say how overvalued or how valued is the S&P right now. We chart it on there. The further out you go towards where we currently are at 23, 24 is the highest of the chart. The further out you go, i.e., the more overvalued stocks are, the lower the return is annualized over 10 years in the market historically. So looking back. So whether these predictions are accurate or not, this is concrete data from the past that says the trend line is very strong. The more stocks are overvalued, the more you have to pay to get $1 of earnings, the lower your returns are over the next 10 years of the market. Which makes sense, right? Because we're paying so much more now. Like you're if you have to put up much more money up front to get a return of $1, the expectation over the next 10 years is that you're like your cost basis is so much higher relative for that
Yep.
dollar of production. It just makes sense. It's intuitive. And so what this chart would be saying, if you look at that, you look at this dot plot and you see this downward trend where more expensive stocks are relative to $1 of value of profit. Again, not the apps, not the value of stock of an individual stock, but just the market itself. Analysts are saying that you're paying so much money to make $1 of profit now. And when that's the case, this trend line shows we can expect a much lower return over the next 10 years. Now, that has a 37% correlation factor, meaning that it's not the only thing that determines what the market's going to do over the next 10 years. So this isn't saying like for sure the market will be flat over the next 10 years or much lower over the next 10 years simply because of this data point, but it is a data point that we should consider. And so that R squared value or the correlation value is 37%. So about a third of the data that determines, according to analysis, what the market does in a 10-year snippet, a big chunk of it comes from this data point. That's a very high R squared value, very high correlation. So that to me is on the opposite side. If I'm the previous conversation about inflation and QE says invest in growth assets because they're going to keep printing money. This to me says store my capital in a guaranteed growth environment because if the market is stagnant for 10 years, now this is inflation adjusted. So what that's saying basically at 23x, they're saying in 10 years from now, you should be exactly where you're at in terms of spending power, which means, yes, it's gone up, but you have not outpaced inflation because that's inflation adjusted.
Right.
So what if we have a flat decade for the next 10 years where we match inflation, but our spending power doesn't increase relative to our performance or to our relative to our input?
We're worse off.
Right. You're worse off because you've just lost 10
You
years
have
of
less
growth.
money.
Just
Yeah.
yeah. So that's where I love having that's a data point for again the saving side of it, the
Guaranteed
guaranteed
savings and growth.
compounding growth.
Yeah. Uninterrupted, which is the key there
Right.
because you're uninterrupted
Right.
compounding. So you are increasing your purchasing power of the dollars that you've stored.
Yeah. So we've presented a couple different headlines kind of bundled into two competing narratives. One says go long equities, one says tighten up and get into life insurance basically. For my perspective, that is the takeaway of the second side. Get into cash value life insurance. You want guarantees, protection, you want the tax-free nature of this compounding because a 4% internal growth rate tax-free is more like a 6 or 7% taxable rate, right? So that's
Full
pretty competitive.
increase. It is very competitive. And the other cool thing about that, like we've spoken about over and over, is you can do both. So
Right.
while we have these dueling narratives that you're talking about, it's the prime example of why you should be putting into this perfect savings and protection asset that you can leverage and protect and have that wall of protection around that capital. So even if it doesn't work out, and move it into things that are part of the growth asset and do both at the exact same time. It's actually just it's such an intelligent, it's almost like playing, in the options world, like you're going to have you're going to buy a put at a certain point. I don't do that, but a lot of different strategies do. They'll buy a put when they're selling calls in order to protect the downside.
Or
So
even
yeah,
if you're just buying stocks,
yeah,
even if you're not
you're
buying a
playing
call, you're
both
just buying
sides of
stock.
that.
Yeah. Now, and that's what a concept that you laid out a couple days ago with Joe. That's a perfect, like, what was the concept that you explained that you drew out on the whiteboard when we were doing the live webinar with Joe that encapsulates this purpose?
Oh yeah, that's just the two parallel paths of wealth, and one of those is the protection path that everybody's on these two paths. Everybody's walking two roads at one time, whether they know it or not. You're on the protection road and you're on the wealth road, and the protection road is all about protecting yourselves against liabilities, against disabilities, and against death. And it's about the amount, the position, and the type of protection you put around those things in order to let your wealth curve grow, because that wealth road that you're on, that's all about capital for short-term, long-term needs. And that happens over time regardless of what you do. Some people have great ways to expedite that time, but no matter how fast you grow it, that curve is always the largest at the end. It's a parabolic curve, so it just keeps getting better and better over time. But there's all sorts of things that can disrupt that wealth curve of growth. And those are the things that we have to protect against. And the reason we position liability protection, disability protection, life insurance protection, because within those three frameworks, all kinds of things can go wrong in your life that will destroy the wealth curve. And
Right.
so if you're not walking both paths and you're not taking care of both paths, you can almost guarantee that the lack of protection will destroy the wealth at some point. Almost every one of us experiences something. We experience a disability, we experience a job loss, we experience a market crash, we experience a death, we experience divorce, we experience lawsuits, all sorts of things. We could probably list that forever. A house fire, you go on and on and on and on to all the things that you've seen go wrong in people's lives. And if they aren't properly protected, it will wreck them financially.
Yeah.
And then you're starting that curve over, and that's the whole point, is that the strongest point of that curve is the end. It's 30 years from now. And if I have to if I've already built that for 20 years and I'm starting back at square one, I'm never going to see that steep point where the wealth is generated at the highest pace.
That just brought to mind kind of a visual when before that webinar we did with Joe, before when the day of, when he sent out a notice that we were doing it, because we only sent out to our audiences the day of, and we still had about 40 people that stuck around the whole time. So for a day of,
Yep.
I feel pretty, those are pretty good attendance. But the email that you sent out ahead of time was kind of priming the pump for why you need to be thinking about the protection side just as consistently and with just as much thought as you do on the growth side. Again,
Absolutely.
always the deficiency is on the protection side, and then the savings and the growth. Like people have it, or financial planning industry, Retirement Inc. has in the reverse order. But what he's talking about was a story when he was in Tennessee visiting his brother, I think around Thanksgiving. Like this was last month,
Yeah.
I understand.
This was a couple weeks ago. Yep.
Yeah, he was with spending time with family at his brother's house in Tennessee, and I guess I can't recall from the, but basically like maybe it was like his sister-in-law was nursing a child or putting a child down or something like that, and she was like, "Hey, do you guys hear that crackling or something? That's what is that? Firecrackers or what?" Like just kind of like innocently just hearing a sound, and then something seemed off, and the brother went and however he came to look at the attic. Basically, I'm picturing like opens the attic door and just smoke comes billowing out. The whole attic's on fire. This house, and they've been in there content for who knows how long that had been going. Insulation goes up pretty quick, so I imagine it can't be been a raging flame for too long. But I bet if you had been standing outside that house looking in, you would have seen it before they did.
Yeah.
And and so he opens it up, and all of a sudden it goes to like full time like hop into
Get out.
action mode.
Yeah. Yep.
We have we have a few minutes before this house is going up in flames, and it did. It went up in flames. They quickly switched from we're you know like sitting on the couch watching football, or we're just hanging out, we're chatting around, having a glass of wine, just chatting or whatever. Life is happening, normal life, and then all of a sudden, get out right now, we're about to die. Like that could happen in a blink. And he
Yep.
said that if they had been sleeping when that happened,
They'd probably
they
be
might have
dead.
they'd all be dead probably because
Yeah.
how quickly it went from like the attic's on fire to the whole house is in flames. It sounded like it was about 5 minutes. So if they had been sleeping and missed a few minutes of preparation, they'd be gone. Right now, that's a house, that's an asset that just went up in flames like that. Fortunately, Joe's brother had protection, great insurance. It's not gonna be a loss to him on paper. But imagine that same visual, this house that just engulfs in flames suddenly when you're unprepared for it. You have 5 minutes to get out. Imagine that happening to your stock portfolio. What could happen there, right? All these things we talk about: divorce, death, disability. Like imagine the visualization of your stock portfolio, your
Up in
options
flames.
trading portfolio. Just gone.
And I and you hate to see it, but it's not an isolated event where that happens to people, and then they continue to go down the wrong road. I mean, you hear about people that commit suicide because millions vanished overnight
Right.
in that sort of event, and it's partially because they don't even know what to do next. They're not protected. They go from hero to zero overnight, and something they couldn't control potentially, or they screwed up and lost the farm, and that just leads to further disaster if you don't have proper protections in place, or you don't have a place you can at least squarely start over from by being protected. So
Yeah.
yeah, it's so
Imagine you walk
important.
out to your mailbox right now and there's a letter, and you have a kid in college and they hit someone with their car and it's your car, you're the title, and now you're getting a letter from a lawyer saying you're being sued for $2.5 million. Lawsuit drops at least every minute in the US. I can't remember the stats, but at least once a minute a lawsuit is dropped. They don't all go to the finish line. And the average case size, I believe, is $1 million or in that ballpark. You're one of those cases. You get that letter and you're being sued for $2.5 million. What are you going to do? How many of your assets can you circle the assets on your playing board right now that are protected from that? Well, in most states, your life insurance is.
Yeah.
But how many of their other assets are protected from that? Your Roth IRA, that's protected. Is your home protected? Is your rental property? Or your stock portfolio? How are you going to pay this if you lose this judgment? That is a visualization. That's where that stock portfolio, your growth, your mutual funds could just evaporate into thin air. They could burn up like that. So it's a super prevalent thing, and I like that dual paths of preparedness because these two things we just told you, these two overarching macro narratives indicate different things. One strongly suggests R squared value is like, if you know statistics, R squared value of 0.37 is high. That's telling you we might have a flat decade in the stock market per all previous iterations. The inflation, the debasement trade, QE, those are telling you you better be ready for this train ride, this rocket ship, because the equities are gonna go to the moon, right? Because they're gonna keep printing this money, they're gonna keep spending, and then therefore keep printing. So what do? You do both things. You get on both tracks, the dual paths of the economic preparedness there. You have your protection, you have your guaranteed growth, you also have your speculative and your investment growth, right? You don't want to rely on just one or the other. But now let's, what are we going to throw into this mix that's going to just disrupt everything like a dildo at a WNBA game? Just attention's gone, no one's looking at the game, right? We're all just looking at this thing lying on the floor, and who's going to deal with this, right? That's AI, right? AI is throwing a wrench into all of this discussion, because all previous macroeconomic truisms might be going out the window. They could be, and it could go in either direction, right? AI is making everything efficient. AI is taking what used to take a year of development and coding can now be done in 60 seconds. Before we finish this podcast, you could log in, find an AI app that will create a website for you like that, right? Jobs gone. Time takes to do things collapsed, right? So there could be enormous positive benefits for our time and the efficiency of our capital. There's a reason that a company like Meta, a $1 trillion company, is increasing at an insane 20 to 30% a year, right? That's unheard of in the last 150 years of capital and finance, right? Unheard of, right? So that's AI potential. But then the other side of the coin, these companies are putting hundreds of billions of dollars into AI, which has produced zero tangible return dollars in the stock market. So you'll
So
hear about the
far.
AI bubble. You hear about the AI bubble over and over and over. Now, is this Amazon, who is not producing a single dime of profit on its way to becoming a behemoth? Or is this just another bubble, right? And so there's different ways that this could go. But again, it's another data point to me that's like we had before: go long, buy growth assets because they're going to keep printing. We also had save and invest in guarantees and safety because we're highly overvalued. And then comes flying in, lands on the court, AI, which way it's going to blow up, and it could blow up in the positive or like just forget everything we know and assume that anything can happen. And again, that just reinforces the same narrative.
It's sort of like a
Prepare.
slow move. No, it's quickly moving, but it's a greater time frame Black Swan event like AI, because it's entered our life as, hey, go into Chat GPT. For most people, AI has actually been around a lot longer, even which this is going to be published on YouTube. They've been using AI for their metrics since like 2015 or 16. So it's been around longer than people were thinking, but people's first introduction on the most part to AI was ChatGPT, OpenAI. And that was about what, 2020, 2021? I can't remember the first iteration of that coming out, right in that one of those 2 years, I think. And here we are in 2025 looking at potential for Tesla's Optimus Prime and seeing them walking around within 2 years. Like, so it's almost like
Less than
it's
that,
like
I
this
think.
Black Swan event that's happening over inside of a decade that can change things. Normally we think of a Black Swan event as like something dropped, a hammer dropped and it was like everything was different. But this one's kind of like a little bit more of a time frame. But I still think of it as a Black Swan event because nobody saw it coming and nobody knows how to predict what's going to happen after. But
Yeah.
we're watching it develop in real time. It's a bizarre thing that I don't know that humans have ever experienced, and I don't think
No, I
anybody
think
knows how to deal with it. Like, I don't even know you can't even describe it because it's not a black swan, but it's going to shift things so quicker than we can react.
swan of color is the appropriate term.
Is it really?
Let's be PC here. That's what they would say. That's what the idiots at Harvard would say anytime. It's like, I just think
It's a
the of
trans
color.
swan. It's
Yeah.
a trans
The,
swan.
something of color is so stupid. So I would always just for fun be like, we're talking about whatever stupid thing they're learning, but I'd always say colored people just because I'm like pretending like I was confused that I didn't understand the difference between colored people and people of color, which is a nonsense differentiator. But to them, it's like one is correct and you have to say it, and it's like they swell up with just joy when you use the term people of color because inherently that just means you're like should be
You're sending the right signals. Yeah.
yeah, you should be treasured because you're brown is like their mindset first and foremost. But then you say colored people, it's like it's the worst thing you've ever said, even though it's just flipping the two words. It's full scale retardery, but whatever. Anyways, no. So whenever I hear something like Black Swan, I always think back to those days where they would correct me when I'd be like color people, or if you were just like, oh, like yeah, this whatever. If you just say black, they just say, oh no, of color, and it's like, okay, whatever. Like
Swans of color.
I'm going to ignore that and just pretend you don't exist. But now I think like Swan of Color, just or like Black Friday, the Friday of Color, something. But anyways, yeah. I mean, you think of like 30 years ago, 1995. Imagine what the internet was. Like you're playing Ski Free on your first ever family computer, to what it is now, to where like I could have a meal delivered in the next 30 minutes just from this, right? So like the scale of what's happened in 30 years from the internet, that's now what happens in a year, like what happened in 30 years for the biggest development in human history as far as productivity and technology, the internet, that's happening year over year right now. So like a year ago, the capabilities of AI were analogous, I would say, to like 1995 internet compared to what internet is now. It's so unfathomable to anything we can measure. And it's only going to increase. So what's that going to lead to? Like, I hope after this episode you understand some kind of like core macro concepts and terms a little better, but I also hope you're confused as to what to expect for the future, because it is certainly, we know it's unknown, but we have conflicting data here, and the takeaway again is prepare for both.
Yeah, you just made me think of something. I had to look it up to get to remember it perfectly, but in 1994, did you ever see this clip where Bryant Gumbel and Katie Couric and some correspondent, they were confused by email addresses like violence@nbc.ge.com asking, what is the internet anyway? And they were trying to figure out what the @ symbol meant.
No, I haven't seen
Like,
that.
it's absolutely hilarious when you think about it. And that was 1994. That was 31 years ago. And these people who were prominent news anchors were like blown away, like laughing about this stupid email thing.
Yeah.
We're there again.
Yeah.
We
Yeah,
kind
it
of
really
laugh
is.
about the idea of a robot, gardening, and here
Doing your
in the
dishes
future,
and doing your laundry.
we're going to probably see that.
Yeah, in the next year. I mean, I think they're coming out this year. It's like the first ones will be like publicly available, I believe, in 2026.
Oh, is it 2026? Okay. I thought it might have been
I
27, but
think the first round, I'm sure they'll get better and it'll become normal, but it's just a wild world ahead. And I just think that to be
that's
so,
exciting.
it is. I mean, it's interesting for sure, but to be so scope locked on any one narrative, like the dollar is going to collapse and go to zero, so you need to have gold and raw land. On the other end of the spectrum, to like, you have to be invested in the stock market because asset price inflation is the only thing that matters. To somewhere in the middle, that I
Both.
want to have assets I own. Like I want to have both. I am in the middle there, but I'm also like, you just don't know. I mean, if the dollar has 30 more years and all of the narratives that have been wrong so far of the dollar's going to go to zero, how many times we've heard that in the last 5 years in particular, if it holds on for another 30 years and you just like impose austerity on your family because you think that the dollar, it's like, be prepared for all of these things and you can do all of it. That's the cool thing. It's like, you can do all of these things, and the asset that we talk about unlocks the ability to do all of those things simultaneously, which is just awesome. But
Yeah.
I hope you're confused.
And on those two parallel paths we talked about, like we're talking about protection, only one of those, I want to reiterate, enables you to both protect against one of those inevitabilities and save your money and move it into growth assets. And that's the whole life insurance, especially as we design it for IBC. So
Yep.
it's awesome because it covers the whole spectrum of everything we're talking about. We can do all things in the financial sense, not all things, but we can do a lot of things with it. It's multifaceted and phenomenal as the foundational asset.
I can do all things through IBC, who strengthens my portfolio.
I don't know.
That's probably not kosher.
Yeah, but it's definitely not kosher.
No, that's true. Yeah, there you go. But anyways, so yeah, so I hope you're a little more confused about the future of what's coming, and I hope you are willing to explore and consider all of these possibilities and prepare for them. And if you want to have a conversation about how you can do that, reach out to us.
All right, let's hang it up because it's 3 o'clock Eastern time here, and that, you know what that means? It's time
It's
to
2
roll.
hours until 5 o'clock.
It's
Oh, yeah.
time to roll.
That's right. It is time to roll our options. All right.
Time to check the trades,
good.
man. So to
All
fight
right.
against that, to fight against inflation. All right, man.
Yep.
Talk to you again. If you enjoyed this, like, subscribe, share it, please.
All right. Yep. Cheers.
Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
This is Brian and Hans signing off.